All right, welcome everyone. We're going to give everyone about 5 minutes or a little less to join in. Welcome everyone that's just joining. We're going to get started in just a couple minutes. Just going to give a chance for everyone to go ahead and log in. So this webinar today will be fully interactive. So if you guys have questions, comments, feel free to use the Q&A. Feel free to engage with us in the chat. We do have a tremendous amount of information to cover with everybody. So we're going to run through it in a nice, concise, tight manner. Going to get through everything. But of course, we will have time at the end for questions, comments, anything that we didn't cover. So if you guys have anything, you can drop it in the chat, or you could wait towards the end and ask your questions at the end. We'll also provide all the panelists' information for everyone here. So at the end, feel free to take screenshots of the slides, and you guys can reach out to any of the panelists with additional questions, or if you need any further guidance. Today's webinar, of course, is the art of house hacking. This is the secrets to unlocking your first investment property. We all know how the real estate market is or has been lately, very challenging in terms of pricing, very challenging in terms of competition and interest rates as well. So we hope with this webinar, we'll kind of provide some insights, some guidance on a different alternate strategy, something that you may have not considered before, or something that you probably have considered, but perhaps are not aware of all the different options available to you. So we're going to get into it in just another, let's call it about a minute and a half or so to give everyone else a chance to sign in. Room is filling up, so I don't want to wait too long. All right, so we're going to jump in. For everyone that is in the room, thank you for attending our house hacking webinar. It's the art of house hacking, unlocking your first investment property. We are going to be talking specifically about our northern New Jersey metropolitan market. Guys, this is fully interactive. Ladies and gentlemen that are joining us, please feel free to drop your names in the chat, where you're from, just getting a little feedback from the people that are attending. And also feel free to drop in any specific things that you're looking to learn today from this webinar. If we don't cover it in our talk, we can definitely cover it at the end for everyone. So without further ado, let's go ahead and jump in. First, let me start off by introducing the topics that we're going to cover today. So we're going to be covering a wide range of things. First of all, what is house hacking? We're going to talk about finding the right property, 4 different strategies that you can utilize for your purchase of a rental property or an investment property to house hack. We're going to be going over budgeting for your investment, financing options for house hackers, and of course, qualifying for a mortgage. Then our attorney is going to speak about the legalities of owning rental property or doing a house hack, how you want to structure ownership in terms of setting up the purchasing with a family member, friend, partner, what have you, and then navigating landlord and tenant laws. Then we're going to also talk about finding and screening tenants, property management tips, a cash flow analysis, and tax considerations for owning a rental property. Lastly, we're going to jump into a little bit about insurance, understanding insurance for rental properties, especially some of these unique situations that we're talking about, and then also risk assessment and different types of coverage needs depending on exactly the type of property that you're looking to purchase. Okay, so obviously we have a ton of material to cover. So let's go ahead and jump in. Again, guys, your participation is needed. Much appreciated. This is meant to be fun. It's meant to be interactive. Please ask questions in the Q&A. You can engage with our panelists in the chat. The chat is fully open to you guys. So at any point, if you want to connect and ask a question, please do. And we do want this to be, a fully interactive event. So I'm going to go ahead and get started. My name is Silvio Lavrador from the Net Positive Real Estate team from Remax Select in Montclair, New Jersey. And so I'm going to be discussing, first of all, what is house hacking? We're going to talk about finding the right property for your house hack, and then 4 different strategies that you could implement. So what is house hacking specifically? So house hacking is a strategy whereby you purchase a property, you're going to live in part of it, and you're going to rent out the other parts of the property to offset your living expenses. Okay. So in this case, what would be the benefit to doing a house hack? What would be the benefit of buying a property and renting it versus just buying a regular single family home? Well, for one, you have reduced living expenses, income generation. Obviously, you're receiving rent, so that's going to help pay for some of your mortgage and other costs. You get to invest at a lower risk because you can purchase a multifamily home and live in the home. So it's a little bit less risky of an investment. You have tax benefits of owning real estate. There's financing advantages of owning real estate as well. You get to build equity in a home long term. And then another option is lifestyle choices. So you may be unable to afford a single family home in a particular neighborhood, but because of some of the financing advantages, you may be able to own a multifamily home in that neighborhood. So it gives you different flexibility with lifestyle as well. Why house hack? Okay, so if you're thinking about purchasing a property and you're deciding on if you want to make it an investment type property or if you just want to buy a home to live in, these are the type of factors you want to consider. So one would be your investment goals. Are you looking for long-term or short-term? 2 would be your exit strategy. Do you want to sell the property or are you planning on keeping it? You want to look at future lifestyle changes. For example, if you're planning on growing a family or if you don't plan on growing a family, that might influence whether you want to have people renting inside your home. Property management, are you the kind of person that doesn't mind changing light bulbs, fixing faucets and making repairs when needed? Privacy concerns, if you're going to be renting a part of your home or if you're living in a multifamily home, obviously it's less privacy. And then upfront costs, because when you buy a rental property or you're going to prepare a home for rent, you do need to spend additional money to make sure that it's meets the standards for a good rental. So when you're looking for a property that might be a good candidate for a house hack, you want to look at a few different things. One is financial viability. So how does this property look in terms of cash flow? Cash flow analysis is very simple. It's basically your total expenses monthly subtracted from your total income. Okay, and that gives you the net cash flow that property will produce. And then you can also look at return on investment, or ROI, as another metric, which is your expenses, or I'm sorry, your net income, which is your income minus your expenses, divided by the purchase price of the property. And that percentage will give you an ROI. The other thing you want to look at is property type and layout. So are you looking at multifamily units, like a 2-family, duplex, triplex, even a 4-unit? Or are you looking for a single family with potential? Perhaps it has a guest house, perhaps there's an apartment space above the garage, or maybe it has a full finished basement with two separate entrances that could potentially be used for rental as well. Location is obviously very important. So you want a location that has good rental demand. You want property values to be stable. So areas where there's, for example, near a downtown area, near major commuting corridors, or near college campuses, near major jobs and industry are always good locations for a potential rental property. So now I'm going to discuss 4 unique house hacking strategies. These are different ways you can get into real estate via the house hacking method. So number 1 is very simple, buying a multifamily home. That would be a duplex, triplex, fourplex. You're going to live in one unit and you're going to rent out the others. So of course, this is just a classic way of using rental income to help subsidize your housing costs. Tactic number 2 is to have a single family home with roommates. So you purchase a single family and then you're going to rent out some of the rooms to other individuals. So this works well in areas with high demand, such as in cities or places with high living costs. The key here is, of course, to ensure that the layout offers privacy and that there's sufficient space. The third is something we're going to talk about a lot, and this is called accessory dwelling units, or ADUs. An ADU is, for example, an apartment, like a basement apartment, a garage that's been converted into a living space, or a detached guest house. You can live in one part and then rent out the other. This space offers a little bit more flexibility than renting out just individual rooms. And then a short-term rental is another excellent way to house hack. This has become more popular with things like Airbnb. So in a short-term rental scenario, you would basically have a primary residence and you would rent it as a short-term rental. So this could be part of your home, like your basement, your attic, or you could rent out your entire home while you travel and go on vacation somewhere else. So that was kind of the basics on the foundations of house hacking and where to find property. So now I'm going to switch it over to my buddy Derek, who's going to take over and talk a little bit about financing and mortgage options.
All right. Great job, Silvio. Thank you for that. What's going on, everyone? My name is Derek Rooney. I'm with United Mortgage. Thank you guys for coming on here. You guys are taking the time in your day to learn about house hacking and bettering your financial future. So, that's awesome. I'm going to go into financing your first purchase, financing the purchases that follow that one. But before we do that, I want you guys all to envision yourself now, buying your first property, because that is, we're going to go over all that stuff today. So it's a cool experience, and you're going to better your financial life. So how you're going to go about that and how you're going to start the process is by setting yourself up to be pre-approved. The best things that you can do to start that is paying down your debt. The less debt you have, the more affordability you'll have, in my eyes and in the investor's eyes to get a loan. Increasing your credit score is huge. The better your credit score, the better the terms of the loan are going to be, the better your interest rate is going to be, and overall, the lower your monthly payment is going to be. So having the best credit score is huge, and it also can decrease the amount of your down payment depending on the loan product that you choose. So 3 things that we consider when going about the pre-approval is, number 1, your income. So if you're a W-2 employee, you receive a W-2 at the end of the year. We go through and we utilize your gross income. If you're self-employed, we use your net income, and that's going to come into play here in a little bit. The next thing would be assets. Assets as in bank accounts, 401ks, investment accounts, whatever you are using for your down payment, and then your credit. So credit is huge. We also look at credit not only to see your credit worthiness, but we also to see your monthly debt obligation, meaning, your car payments, your student loans, your credit cards, whatever it might be. So how we calculate income and how we calculate what your approval amount will be is we use something called a debt to income ratio. So on a conventional loan, and we'll say this for all cases, is we want your total debt, meaning all your credit cards, all your student loans, all your car payments, add the monthly payments of those up, and then we add your housing payment up, meaning your principal, your interest, your taxes, and insurance on the anticipated property. And we want that to be about 50% of your monthly income. So if you want to qualify for a $4,000 mortgage payment or a $4,000, mortgage payment, we want to make sure that you're making about $8,000 a month per se, gross income or net income if you're self-employed. But there are other ways around that if that might not be the case. So there's the DSCR loan, bank statement loan, and a non-QM loan. So we're going to actually go over those on the next slide here and go over down payments and requirements for those. So conventional loan, anything 1 to 4 units, you're going to be putting about 5% down if you intend to live there. If you don't intend to live there, you have to put a little bit more down. Anything 2 to 4 units is going to be about 25% down, and a single family would be about 15% down. Those are minimums. So those are properties that you were just buying to rent out. You're not going to live in any of the units. But for primary, say if you are buying a 4-family and you want to live in one of the units, rent the other 3 out, you can put as little as 5% down, and that did just come into play this past year. And the guidelines change for that. So that's a pretty cool product. The next is FHA. So FHA is the Federal Housing Administration. Those loans you have to live in. There's no investment FHA loan. You have to live in at least one of the units for 12 months, for at least 12 months. So anything 2 to 4 units, you can put as little as 3.5% down. And a single family as well, you can put as little as 3.5% down on. So DSCR loan. This DSCR stands for Debt Service Coverage Ratio Loan. So what that means is if you have a mortgage payment, so we take the anticipated mortgage payment on the property, we add the principal, your interest, your taxes, and insurance with however much you're putting down. Typically, these require about 15% down minimum with perfect credit. But so we take that, and then when you go to get an appraisal on the property, the appraisal company does what's called a rental appraisal. So they will see what the market rent would be for that property, and if the market rent is greater than your anticipated mortgage payment, that's all it takes. Then you qualify for a debt service coverage ratio loan, meaning, the rent is going to cover your mortgage payment. That's it. And then next up, we have a bank statement loan. Bank statement loans are tailored. I mean, is anyone in here, put in the chat if you guys are maybe self-employed, because this is going to be, and if you are self-employed, definitely listen up here because this might be something that could be tailored to you. So bank statement loan is where, like I said, if you're self-employed, we don't go off the gross income. We go off what the net income is. So whatever you have on your tax return, whatever you file on your Schedule C, or if you do an 1120S, however you file your taxes, we use the net. So a lot of the times as self-employed, we write off our expenses. So our income doesn't look as much as it is on the tax return because we write off a lot of our stuff. So we don't have to pay the IRS all our money. So what you can do instead of that is you can take 12 months of bank statements, you add those, add the deposits up over the 12 months and then divide it by 12 months. And that will give you your average monthly income, based off the deposits in the bank statements rather than going off your net income, which in some cases might be lower. It also might be about the same or higher. Just depends on your scenario. This is probably the most important page here, tailored towards house hacking and utilizing rental income to increase your approval amount. So when either if it's a conventional loan, an FHA loan, a conventional primary loan, a conventional investment loan, or even a bank statement loan, if it's anything over 1 unit, we can use, if you intend to live in one of the units and say it's a 4-family, again, we'll use that scenario again. Say it's a 4-family, you decide to live in one of the units and rent the other 3 units out. So we can actually use the rental appraisal to calculate the market rent from the 3 units you're not going to live in and add that to your income. We can use 75% of it, so we can't use the full projected rental income, but we can use 75% of it, which in turn is going to increase your approval amount, since it's extra income for you to buy more house. Because say maybe you can only get approved for a $500,000 single family, but if it's a 4-family and you can use that rental income, maybe you can get approved for $1 million, because each one of those units is going to add to your rental income. And say if it's a single family, most of the time there's no rental income to be used. But if FHA back in October of 2023, now allows you to use accessory dwelling unit income, and we'll go back to the DSCR. I know I skipped over that one, but we'll go down here to accessory dwelling unit income. So I know Silvio touched on that just a little bit, but what that is a mother-daughter, right? So anything, it has to have its own form of entry. So say it's a mother-daughter unit, there's maybe an apartment on top of your unit that has its own form of entry, or say it's a finished garage unit. You can actually use the rental income from that unit to help you qualify for the property, which is typically the only time on a single family that you can use rental income. Most of the time you're using rental income is if you're not going to be living in a single family on an investment property, or if it's a multifamily, you can use the ones of the units you're not going to live in. So back to the DSCR loan, like I said, guys, it's just the rental income, the projected rental income that we get from the appraisal has to just be greater than the mortgage amount. And most of the time it is. I mean, because you're putting a little bit more down on those DSCR loans. The minimum requirement is about 15% down with perfect credit. But if you have a little bit worse credit, maybe it would be 20-25%. It depends on your situation. But back to what you cannot use is most of the time is just anything it's a single. If you're living in the unit, unless it's an accessory dwelling unit, that's the only exception. You can't use rental income on a room. I have people ask me all the time. I have my friend who's going to be living in the same unit as me, renting out the room. We cannot use it as income on our end, but you can definitely do it. You can definitely collect rental income from that yourself. So now to things to consider buying. FHA has the smallest down payment for multifamily. It's 3.5% down. So you have to live there for about 12 months before you buy your next one. So after using FHA, utilizing the 3.5% down, you can buy another multifamily, conventional, 5% down. Most of the time, you cannot buy FHA after buying FHA for your first house. The reason for that being is you can't carry 2 FHA loans unless they're within 100 miles of each other and you have a reason for being about 100 miles away from this house, maybe job change, whatever the reason may be. Another thing, and that's a way to utilize the least down payment to have 2 multifamilies. Buy FHA, 3.5 down, 12 months later, buy conventional, 5.5% down. Also, say if you have a property now that, the properties have been appreciating a lot, maybe doing a cash out refinance to pull the equity out of your current property, and then utilizing it to put money down on another property. So most of the time, if it's a primary residence, we can cash out up to 80% loan to value. Say the house is $100,000, that's the appraised value. You can pull up to about $80,000 of that. I know there's not too many $100,000 houses, but it's for easy math. And then how we calculate rental income on property you already own. So this goes back to the same as if you're self-employed. We do not go off the lease agreement once you have filed taxes for that property. We go off what the taxes show, on your tax return. So whatever expenses you write off, that gets deducted from the rental income, and how we calculate that. So if you intend to buy more properties, maybe don't write off all the expenses on that property, the depreciation, all that stuff, etc. Something to talk to your accountant about. But I would say, qualify as much as rental income as you can if you intend to buy another property in that year. So that's pretty much it for me. And then we're going to go over to Brian.
Oh, I'm sorry, I was trying to mute myself. Tell me something. So everyone, a lot of the things I'm gonna go through, it's gonna be kind of brevity, there's a lot more details and there's very nuances. I always say every case, especially when we're going to talk about landlord-tenant relationships and things like that, are like a fingerprint. Every legal cases, so every situation is unique. And I always highly recommend speaking with someone before anything is. I can't stress the importance of speaking with an attorney before anything moves forward or any questions regarding these relationships. And then feel free to send in the chat if you do. So three topics that we're going to cover is legalities of house hacking, property ownership, and landlord-tenant relationship. That's good. Yeah. Thanks, Silvio. So the legalities of house hacking. So some of these things are the types of homes and requirements. So sometimes when you are purchasing, you may have heard certificate of occupancy, smoke certificate, rent registration. It's a big deal. So this past August of 2024, the courts changed the way that you file for evictions in certain proceedings. That when you're filing, you have to include a rent registration form, which is basically it's if a one or two family, which will go in a little detailed, it's a simple form. Now, if it's three and up, now that's where we're at the bottom where you see something called a green card. It's the Department of Community Affairs registration. If you have any questions, let me know because it is a little complex, but for me, it comes second nature, so it sounds easy. Um, Smoke certificate is required for all homes in New Jersey. That's a state law. That one doesn't matter. The certificate of occupancy, that is township based, mostly county based. It's safe to say most of the counties, Essex, Hudson, Union, and Middlesex are pretty much certificate occupancy counties. Once you start going into Passaic, Morris, Somerset, Warren, like even down south, even Mama County, you start running into different issues. Some have the certificate occupancy, other ones have just a smoke certificate or two. When you are renting it, those are generally required. It's very township based, so you have to also check with the township. Now, the big thing is a three family. If it is a three family and up, you have to have a green card, what's called, and that's a state inspection. That's separate from any smoke or CO. So again, these are just kind of a brevity, but there is a lot more detail. So it's very important to ask when you are purchasing, because if not, let's say you buy a house, it's a four family, and you don't ask about the green card and you close on it, and then you kind of find out there's a whole list of violations or something like that, then it's on you at that point because you're the new owner. And so this also falls into kind of the category of when you're finding out. Let's say I'm looking at this unit. I'm interested in purchasing a three family, for example. I got my green card. I'm buying in Newark. So there are parts of Newark where there are something called rent control, rent restrictions. So you're restricted on how much you can raise the rent per year. It's very important because now let's say if you're even getting the units which are renting low, for example, say $1,000 a unit or something like that. Um, at that point, even if you wanted to raise the rents, you're restricted on how much you can raise it, especially if there's tenants with leases in place. If they're older tenants and you're trying to, empty the place out, quote unquote, and trying to bring new tenants to raise the rents up to par, you have to be very careful because what you do, or even if you try to raise the amounts, it can be considered something called constructive eviction. So again, that's just kind of a legal way to remove people. And this is just some legalities and things like that. So I always say, just, I can't stress the importance of speaking to an attorney, especially with this landlord tenant thing, on what to do. And not only the rent control, you have to be careful as well. Now, a lot of townships, for example, certain parts of Elizabeth, things like that, are having laws like if you're trying to turn the home, for example, into an Airbnb or what's called transient use, a boarding house, quote unquote, or what it may be, there are many different requirements on what you need in order to have it approved, or even if it's allowed. And so you saw, like, for example, in New York City, they started restricting on Airbnb. So I saw a question was the green card on multifamily. The green card, again, it's the Department of Community Affairs. It's basically an estate inspection. They do it every 5 years on the property, and it has to meet certain safety guidelines. Okay. If you, depending on the township, if you pass the CO, you should be able to pass the state inspection. You're required to notify the state to do it. They don't check on you. They'll just give you a fine for not registering. So it's very important to look up the property. There's a website you can look up, um, and you can see if the property has a green card or not. All right. And it's very important because if you ever have to, for example, evict someone, you're going to need that certificate of registration, the green card, quote unquote, for 3 and plus to evict them. Or if not, the judge is going to dismiss your case and you have until you get that green card, you won't be able to move forward. So it's very important. We can move forward. So now a lot of times you're like, all right, I'm buying this home. I'm gonna buy with my girlfriend, my boyfriend, a significant other, family, or a cousin, whatever. So these are very important things. It's called property ownership. It's ways to own the property. And it kind of bleeds into the field of estate planning as well, which is, again, I always think when you do buy a property, you should speak with someone about, I think Derek was mentioning as well, like tax wise, but it's always good to talk to planners as well. You're basically future planning on if it makes sense and what makes sense and things like that. Tenants in common, again, this is just kind of quick synopsis. I do suggest if you have any questions, contact afterwards. Tenant in common is basically like stock ownership kind of thing. You own a percentage in the home, right? You could split it. You most times, let's say two people buy it, you can do a 50-50. Joint tenants, rights are kind of like, for example, if you think of a married couple, wife dies, husband gets it. Husband dies, wife gets it kind of thing. So whoever survives the other gets it. You can also do that. You don't have to be necessarily husband and wife. And then this is where it complicates things with the partnership agreements. If you're purchasing via an LLC, kind of one of those investment properties that you're required to purchase via LLC, depending if you're doing a commercial, different kind of lending policies, or a joint venture. For example, joint venture is kind of a different type of partnership agreement. If you have a silent partner, if you have a family member who's just giving you some money to help out, but they expect to get some kind of, payment back later on or something like that. There's different things you do. So it's something you definitely want to discuss, especially if you are buying just investment properties. Now, if you're purchasing for FHA, obviously the requirements owner occupied, that's very different. Those have its own legalities. But those are just some things to consider because it definitely affects, let's say, for example, if you're buying it, the biggest example is a significant other. All right. And that's not a married spouse. Until they're married, remember, marriage, once you're married, it's a contract, it's a certificate. So you kind of stick together. But when you're just a couple boyfriend, girlfriend, something where the happy relationship breaks apart and you guys bought this home together, then at that point, one person may disappear. I've have cases, of, for example, where you're trying to find the other spouse because now you want to sell the home, or you want to kick the other person off the deed because you want to keep the home, but you can't find them, they're not talking to you. They want X, Y, and Z. So it's very important sometimes to have it squared off on how you guys want to own the property and also what you would like to do in the event if something were to happen. Again, this is just going over quickly, but it's questions to think about when you are purchasing a property is very important. Now, everyone asks, like, what makes a tenant landlord-tenant relationship? These two next slides will go into it. If you ever want to know about eviction law, if you want to Google it, just put New Jersey Anti-Eviction Act. That is what controls in New Jersey evictions. All right, that controls how notices are required, what you can do in eviction, what considered, as I mentioned earlier, constructive eviction, and things of that nature. It's very important. Again, that is a state law. Each township, again, has, like I was saying, ordinances, again, regarding the rent controls, because that can be considered what's called constructive eviction. So there's a lot of things in the background that play around, and also the ordinances for if you require to smoke, what the rent registration is. If there's certain things you have to do, like for example, some towns, someone in Kenilworth, for example, if you don't if you don't register the unit and it doesn't have a smoke certificate, the tenant is allowed to get 8 times the rent, something like it was something of that nature. I forgot the actual wording of the ordinance. So you just have to be very careful. And it's very nuanced based, so it's something you want to research, especially if you're making an investment unit and you're not living there. Then obviously there's different things that come into play with the laws. Owner occupied versus investment occupied, there is a big difference. All right. An example, if you do purchase an LLC, one thing, for example, in Jersey, an LLC has to be represented by an attorney. So if you go to court, you can't do it yourself. You have to have an attorney. But obviously, there's benefits to having LLC tax-wise, liability-wise, and other things like that. So something to discuss. And former landlord-tenant relationship in New Jersey, it's relatively a low bar. Once they start occupying a property, if there's any kind of consideration and they can prove that they've been making payment, then at that point there may be a relationship established, and you're kind of leaving it to the judge's discretion to determine if there was what adds up to being a landlord-tenant relationship. And this leads into the next slide, which is a squatter versus a tenant. Generally, I always ask clients when my first question is if they're trying to, for example, let's say you got the property, you squared out, you bought it yourself, it's your investment property. And now all of a sudden you come to find out you had one tenant you were renting it to, and they disappeared. And you got this guy, Joe, who just shows up, who's there. He's just hanging out. Like, yeah, this guy was renting an apartment to you. At that point, if he's never paid you, if there's no relationship, like he's never paid you in a rent, there's no establishment, you don't know who he is, then at that point, you'd have to serve certain legal notices. And you could file for what's called an ejectment action, as sense below. Again, that's very situation based, and I've seen situations where if they were paying, if they were like kind of renting out like board, it's becoming pretty complex. But if there's any kind of proof or receipts or anything like that, the sell payments, like the history that can show that they paid you some kind of consideration, then you fall into eviction, which is, again, it's a whole different process, and takes longer than ejectment action. So it's very important to know. You can move forward. And again, so I passed the line on to Angelo. But again, any question you guys have, I went pretty quickly through it. Just let me know, because gets more complex. It's very situation based. Any kind of thing that requires the legalities, property ownership, and the subsequent effects of it.
All right, thank you, Brian. So my name is Angelo. I am a financial planner, but I'm part owner of a property management company based out of the Hilton Head, South Carolina area, which is why I was asked to be a part of this. And what I'll be running through is a broad overview of finding and screening tenants, property management best practices, as well as tax considerations as well. So first thing is just disclosures. I'm not an attorney or a certified public accountant. Now, first thing is as far as projecting cash flow. This is more so important when you're looking to buy a actual investment property rather than like house hacking it, because chances are in Jersey, unless you find a sweetheart deal, you're not going to get much cash flow, if any, off of it. So the first thing that you need to project your cash flow is what kind of income are you gonna be getting in off the rents? If you don't know how to do that, there are websites like Zillow you can look at, Rentometer. I would caution against taking that as like the gospel, because a lot of the times I'll see that the rents on there are totally way off. So using a real estate agent or a property manager, they'd be able to get you a really good rental estimate. Now, same thing with property taxes. You can base off of comps, and comps they're just similar properties in your area that surround your property. And based off of what their property taxes are, you can get a good idea on what your property taxes would be going forward. And as far as things that you want to make sure you have covered in terms of expenses, when it comes to real estate, it's not just the principal, interest, taxes, and insurance that you have to cover. If you're owning the property, you're also going to have to take care of maintenance and capital expenditures. So that's where really setting aside a rainy day fund can help with, if the AC dies or you have to put on a new roof, you really need that cash set aside in order to take good care of your property. Now, typically, depending on the amount of units, you set aside maybe a few $100 per unit as your rainy day fund. And after subtracting out your mortgage, taxes, insurance, and your rainy day fund, that's where you get your true cash flow. So, all right, great. You got a property, you ran the numbers, things are looking good. Now you have to find tenants. One thing you really want to be sure of is that you take good, attractive pictures of your units. You don't want it to look like some, flip phone from the 2000s. Freshen up the place, tidy it up. If you want to stage the unit, which means you put in some furniture, that's also a good way to just so that the prospective tenants can kind of envision themselves living there. You also will want to list any kind of amenities either in the property or also nearby. So if you're nearby to a park or to really great schools, you definitely want to include that in the posting. And you also want to just state up front what the rental terms are, what the cost is going to be, the amount of the security deposit, just so that everyone who's checking it out has an idea of, all right, here's what I'm going to be laying out at the front end and on an ongoing basis. And as far as websites to advertise on, you can use Zillow, Apartments, Rents.com, just to get your property out to as many people as possible. All right, now for once you get those applications in, this is where the tenant screening process really begins. And I have this highlighted in bold and underlined. Do not skip tenant screening. Even if someone comes in and says that they're going to pay for the whole year up front, no, properly screen them. Because you want to look at it as you're basically going into business with your tenant. You both are signing an agreement that they are going to pay you your rent on time and that they are going to take good care of the unit. So some general rules of thumb is you want to make sure that the prospective tenants are making at least 3 times the rent every month. So, if it's $1,000 per month for the rent, then you want them to be making at least around $3,000 to cover that. Another thing is and this goes without saying, but you can't discriminate based on race, gender, orientation, things like that. Specific to New Jersey, you're also not allowed to reject someone solely because they're on Section 8. And for those of you who don't know, Section 8 is it's government housing vouchers that certain landlords don't like having Section 8 tenants in their property, but here in Jersey, you're not allowed to discriminate against that. Now, as far as security deposits for your tenants, you're only allowed to keep 1.5 times the monthly rental rate as a security deposit. And the reason why you want to ask for a security deposit is if you have to evict the tenant, and so they're missing out on rent payments, or if they damage the property, that is where you're going to first pull funds from. And it's much easier to pull funds from a security deposit than to have to go after a tenant after the fact to get money out of them. It's quite a process. I'm sure Brian can tell you for sure. And the big thing is make sure that you have a very solid, airtight lease. New Jersey is kind of notorious for being a little more tenant-friendly than landlord-friendly. So you just want to make sure that there's a solid lease that you go through with the tenant. In fact, for the property management company, we have the tenant's initial next to each line or each segment of the tenant agreement, so that way they understand, yes, this, we signed for it. Yes, we totally understand this. Now, for handling maintenance, this goes into that whole rainy day fund I was talking about a few minutes ago. You have your emergency fund. You want to keep it in either a high yield savings account or a money market or treasury bills, which treasury bills are U.S. government debt. So super secure investment. And this is where you're going to get your highest yield on your cash. To where if you have to make some sort of repair or major capital expenditure, these funds are readily available. You don't want to be putting those funds into the stock market or anything like that. Now, as far as who's responsible for what, if a tenant breaks something, then they're the ones responsible for it. Pretty straightforward. Landlords are going to be responsible for everything else. So normal wear and tear, like let's say if you have carpeting in your unit, let's say it's a brand new carpet and the tenant rips it up or something. Yeah, no, that's all on the tenant. But let's say if it's been in the property for a few years and it's just starting to get worn down, that would be on you to repair. And then for tenant requests on things that are, important, let's say that their bathroom's not working, the stove isn't working, the AC dies. In New Jersey, what's written in the laws is the repair has to be performed in a reasonable time frame. There's no like, okay, X amount of days is a reasonable time frame. It's just whatever reasonable is in the eyes of the judge. Otherwise, the tenant can pay for repairs out of their pocket and deduct it from the rent. And one thing I really want to impress on people who are looking to be landlords, happy tenants equals happy landlords. I own a rental. It's a 2-family. Both my tenants, I make sure to take very good care of them. If there's some sort of issue that's on me to repair, I make sure that it's quickly repaired, because the last thing you want are unhappy tenants. Now, obviously, if they're being annoying about little nitpicky things, you have to draw a line at some point. But just try your best to keep them happy and have a great relationship with your tenants. And then I'm running a little over time, so I'm going to quickly run through this. As far as taxes, there's entire textbooks on real estate taxation, so one slide doesn't do it justice. But one of the few of the bigger things is depreciation. This is a way that you can make a profit on your rental property and claim a loss. Another thing is what's called a Section 121 exclusion, where if you lived in a property for any 2 of the past 5 years, so let's say you lived in it for year 1, moved out for year 2, moved back in for year 3, and then moved out in year 4, then decided to sell it, you can, if you're single, exclude up to $250,000 in gains on the property, and if you're married, you can exclude up to $500,000 in gains. Now, the next thing is a 1031 exchange. This is for rental property specific, where you sell a rental property and take all of the profits and move it into acquiring another rental, and you can defer the taxes on that sale. And you can keep doing that over and over and over again until the day you die. And then the last thing I'll briefly talk about is qualified opportunity zones. Here in Jersey, there's a number of them in areas like Newark, Paterson, Irvington. These are areas that the government's really trying to fix up. So if you invest in a qualified opportunity zone, and it might not cover the whole city, but individual portions that you'd have to check into. Let's say if you sell a stock and make a gain on it, you then have 180 days to purchase a property in one of these qualified opportunity zones, and you can defer the taxes on that sale of the stock or real estate or whatever asset until December 31st of 2026. And that's just a very broad overview of it, but there's a lot more to it as well. And then, oh, I see a quick thing in the chat. As far as writing off interest and property taxes on the mortgage on top of the standard deduction. So for that, you would be writing, you would be itemizing your deductions. Now, I'm not an accountant. However, for the portion that is attributable to the a rental unit, you should be able to write off the interest as well as any kind of depreciation. You can have depreciation on that rental unit as well. The unit that you're living in, you can't take depreciation on, but you'd be able to write off the interest and property taxes. And now we have Santiago Garcia.
Hey, thank you, Angelo. Man, great panel here. A lot of information, guys, for everybody. Thank you for joining us. Thank you for your time. And so after you pass all these great professionals that just spoke, you'll sit down with me and we'll talk about how to protect your investment. Basically, understanding insurance about when it comes to ADUs and the rentals. And we're also going to talk about the risk assessments and coverages, okay? So I have a lot of clients, and I don't know if I even introduced myself to you guys. Santiago Garcia from Goosehead Insurance. And what we'll do basically is we have a partnership with all the carriers in the state, and we actually do the shopping for you. So when you are in the market for a home or for a rental unit, you gave us the information, we'll contact all the carriers in the state, and we'll try to get the best coverage for you. All right, so that's what we're doing. So here, what we're going to do is understand a little bit about insurance. So a homeowner's policy basically is anybody that is in the market for buying one family home or 2 or 3 or up to 4 family could have a homeowner policy as long as the owner lives on the property. That is a very important part, and I'll explain more in details when it comes to the risk when it comes to insurance. Renter's policy is basically what I do recommend to everybody that has a rental unit, whether it be a ADU or a just a total property that you rent to others, make sure that everybody has a renter policy. This will protect your investment, and will protect you for any foreseeable lawsuits that could be actually responsible for your tenant. So just make sure that all your tenants have a rental policy and have your name in there as an additional insured. Remember, we're trying here to protect yourself and all your assets. Long-term rental properties and Airbnbs is basically if you buy, let's say, a two-family house, and the long-term rental is basically when you rent someone on a yearly basis with a lease. Airbnb is short-term rentals. There's a difference there, and depends on where you're going with your property. You need to make sure that those endorsements are in your policy. There are some companies that specifically insure your property for Airbnbs. There's others that will insure for the long-time rentals, okay? So just make sure that you have an open communication with your agent and explain how you want to insure your property. Commercial property, it's basically anything that is utilized commercially, a warehouse or anything like that. And that could be a business. It could be anything that will follow under your business. It will need a commercial policy. An umbrella policy, it's something that protects your assets. So let's say you have your auto and you have your home. If you get an accident on your auto, and let's just say that your policy protects you for $500,000, and the lawsuit it's larger than $500,000, and it happens, the umbrella policy will kick in and protect you. If you don't have an umbrella and you're being sued for more than $500,000, the people can go after your assets. It could be your income, it could be your 401k, and it could be your home. So you always want to make sure you have an umbrella policy in place just to protect you in case that your lawsuit exceeds the amount of coverage that you have in your policy. This last two is a builder's risk and a general liability policy. These two goes together. I have clients that buy a house that need to be fixed because they are in a really bad condition. You can do a homeowner policy. You can do an LTR because the property is vacant at that time. So a builder's risk is a policy that is created for those clients that are going to fix their home. So that way the structure together with the materials are all protected in case of an accident. Okay, so you want to have the builder's risk, and then the general liability, it goes together with the builder's risk in case that anything happens on your property. If there's an accident with the people that are working in there, or anybody that walks by your property and has an accident and fell and they sue you, will be protected with the general liability. Go ahead, Silvio. And then here, these are the two things that I want to kind of just explain about why it's important to be very clear with your agent when it comes to insurance. So some of the clients, they call me and they say, hey, I bought this house. I don't live there no more. I'm renting it out, but I want to save $200. Normally, the homeowner policy is less expensive than the rental policies because insurance companies know that the owner of the policy, the owner of the property, will take care of the home. Tenants normally don't take care of the property as the owner does, right? And for that reason, normally the homeowner's policy are less expensive than the property that you're going to be renting it. The problem is that if you don't make that change, from the homeowners to the long-term rental property, and an accident happened, let's just say a fire occurs in the kitchen, and it costs $50,000. When you are submitting all your claims to the company, and the company determines that you don't live there as your policy says, they can deny the claim, and you are taking that loss with you. So I always say to my client, don't try to save $100 or $200 now, because if something happens, you'll be expending thousands of dollars. So it's something that you need to be very careful, very cautious of it, and make sure that you have the right policy with the right with each of your properties. And then lastly, some of the things that you can save when it comes to insurance, it's basically having obviously your auto and your property together. It could be with the same agent, it could be with the same property, with the same company. In my case, I have two different companies. I have one company for my home, one company for my auto policy, but it makes sense to me. So it doesn't always work if you have home and auto together with one company, but at least having a home and auto together with one agent, you will always get a discount as well. Okay. Um, Also, be careful with the claims. Claims, especially right now, insurance companies are very strict and with their underwriting right now, and you need to be very smart when you submit a claim. I have clients that have submitted a claim for $500, $1,000, and they either get kicked out of the insurance company or their policy increase 50, 60% because of one claim. So you want to make sure that you're smart with your claims, and obviously the least amount of claim that you put into your policies, the best rate that you get from all the companies. Guys, we're open to questions. Just want to make sure that you guys understand all this, everything that we have. So we're right here for you, and I'll pass this on to Silvio now.
All right, thank you guys. This was an action, informative, packed hour of information. I hope this was helpful for everyone. I hope we were able to cover a lot of ground. We do have a few minutes. We did leave some time open at the end, even beyond the hour mark, if there are questions. I know Ajit had a couple good ones that hopefully we were able to answer. But yeah, I see Koya, Gabriella, Gwen, Hannah, Jamie, Juan, Taylor, anybody that wants to ask a question, give us some feedback, or if there's something that we didn't cover you'd like to know more about, now is the chance. If you guys want to drop something in there, we're happy to answer it. But if not, you guys have our contact information here. Feel free to reach out to us individually. Again, my name is Silvio, a Lavrador. I'm a licensed realtor with Remax Select. You had Derek Rooney, mortgage lender with United Mortgage. Brian Miranda, real estate attorney with Miranda Law Group. Angelo Cirinelli with Visconti and Associates. He's a financial planner. And of course, Santiago Garcia, our insurance agent with Goosehead Insurance. So we'll hang out here for a few minutes in case anyone's got any questions, but if not, then we wish you guys well on your investment journey. And please, if you need any help in the North New Jersey area, you've got an awesome team here that's always able to provide guidance and help you along the way. So thank you everybody for attending. And yeah, we'll leave it there and just check out if there's any questions and go from there. All right, I see we had a couple more questions. Where are the highest rental demands in North Jersey? That's a good question. So rental demands, yeah, just like Derek said, anywhere that's near major public transportation. I mean, we're seeing huge migration coming from Manhattan, from all the boroughs, actually. They're all moving down to New Jersey because they're getting a little bit of better deal on rent. So, of course, major city areas, major commuter hubs, downtown areas. Union City, yeah, I mean, Union City is phenomenal. You're very close to the city. It's really up and coming. They've done a lot of development there. I know they have major apartment building projects going on in Union City. It's a little bit more affordable than Jersey City and North Bergen. So I think Union City does have a lot of value because it's seen as perhaps a lower entry point. The home prices are a little lower, the rents are a little lower, but you basically get all the same convenience as living in Jersey City, or very close to it. So I think Union City is fantastic for sure. Ajith, man, coming through with the good questions. Anybody else questions for the panel? All right, well, we're up on time. So I guess that's it, man. If you guys want to unmute and just bid farewell to our attendees here. Ajit said, thank you for the informational session. Thank you for participating. Thank you for your questions. This is our first time running this particular type of webinar, so we wanted it to be a little bit different. We did want it to be informative, so we really appreciate that feedback, and hopefully this is successful enough, and we could do it a few more times. So we'll see. But thank you, Ajit, for that feedback. We appreciate it. All right, so that's going to wrap it up. I'm going to go ahead and end the session, but I do appreciate everyone attending today, and like I said, we'll hope to do this again soon. So thank you so much, guys.
Thank you all.
Bye.
Thank you.
Thank you, everyone.